Hey there, everyone. Welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at Stockcharts.com, coming to you all this week from a very sunny and beautiful Dubai in the UAE. It's a pleasure to be joining you this week from a very fascinating part of this planet. It's my first time to the Middle East. It's been a pleasure. This city in particular is a very diverse city with a lot of people from a lot of different places. And it's been a pleasure to meet many of you that I know have mentioned that you've watched this show for a while. And thanks so much for giving me some faces to match some of the comments that I've received from many of you since we started the show a number of years ago. Really excited to continue to as I process all the conversations that I've had here in Dubai at the CMT 2024 Summit. Look forward to sharing some more insights with you here in the days and weeks to come. But for now, we're going to do a special all mailbag episode because I am in transit heading back home to Seattle, Washington. And so we're going to answer some mailbag questions that we've received. As a reminder, our mailbag is always open. Email is the best way to get your questions to us, thefinalbar@stockcharts.com. We're also on X. Just tag us in a comment at FinalBarSCTV. And here on YouTube, just drop a comment below the video you're watching on the Stockcharts TV channel. We'd love to hear from you, and we'll hope to answer one of your questions in our next mailbag episode. With that in mind, let's get right to question number one. Dave, which indicators do you prefer to decide to exit a position? And I love this question. And again, there are certainly themes to questions that we've received, and this one is one that we've certainly received in different forms over time. In terms of exiting a position, what I love about is that. And this is a conversation I've had with a number of people here. And in fact, it really was one of the themes of the conference here in Dubai was, we think of technical analysis. I know when I was learning the technical toolkit, you thought of it all about identifying long ideas, right? Like where could you learn when to buy AMD? How could you know when AMD was bottoming out or know when it pulled back in October of last year and sort of get that perfect entry point? And that's certainly, a part of the technical toolkit is helping you identify buy ideas, for sure. I mean, that's certainly a core part of the question that we're all trying to answer as an investor. But I would argue, I think technical analysis is even better equipped to help you identify when to sell. And one of the speakers, Frank Teixeira, who's a longtime fund manager at Wellington Management in Boston, and now runs his own family office outside of in the Boston area. He talked about how fundamental analysis, really doesn't have a great sell discipline, right? There's not a natural risk management component to fundamental analysis. It's really understanding the characteristics of the company and determining whether you think it's a good investment or not. Technical analysis arguably is very well equipped to help you identify when to sell. So here's some of the things that I look at. And I have a chart of AMD because this, I think, represents a lot of leading growth names that are currently in established uptrends. The question is, when do you want to sell? I think there are two general ways you can think about selling, right? You either sell when there's been a big run and you want to take profits, and that's more of a conservative approach, sacrificing further upside to just lock in current gains, and you have zero risk of losing that if you sell the position and you're out of the stock. I would argue most technical analysts would tell you that when there's a chart in an uptrend, you want to stick with that trend as long as possible. One of the great market maxims is, let your winners run. And that's certainly something that I think you want to have in mind. So with the chart of AMT that's going up, I would say as long as the chart keeps going up, that's still bullish. So keep in mind. So how do we determine it's still going up? Well, I think basic, Dow theory, are we making higher highs and higher lows? Most recently, the chart of AMD, it's had a number of pullbacks. And you'll notice as we've pulled back, we've continued to make higher lows. And I think most recently there in mid-December to early January, in late January to mid-February, you can see we pull back to that previous swing low. We never really undercut it. We've remained above an ascending 50-day moving average, which is another thing I would look for. So, again, as a reminder, that tells you the trend is up. So what would tell you, to sell or to tell you that something's different? Well, I would say not holding support on a pullback is probably one of the most important things, right? Do we stop making higher lows? We make a lower low. That's often a danger sign. Do we break below an ascending 50-day moving average? That might be something I would look for as well. When I'm looking at RSI, does the RSI break below 40, which for me in a bullish phase, that 40 level is kind of a magical level because that usually means as long as we remain above 40 on pullbacks, that we're still in a primary uptrend. I want to know when we're not in a primary uptrend anymore. I want to know when we roll over. And so some of those things might tell you that conditions are changing. Now, there are also way more, statistically meaningful things that you could look at. I would encourage you to check out in the overlays section. Two things that I would point out to you. Number one would be the parabolic SAR points, which is a stop and reversal system. This is an indicator created by Wells Wilder back in the 1970s. So if you know RSI, the same book where he announced RSI to the world as a new indicator, the parabolic SAR, the parabolic systems or parabolic studies as it's called, was in that same book along with the ADX and other indicators. It's basically a stop and reversal system. It's a trailing stop that he calculated. I would encourage you to take a look at the chandelier exits, which is a series of indicators driven off of average true range. It was really popularized by Dr. Alexander Elder in I think it was his book, Come Into My Trading Room, where he talks about the chandelier exit strategy. But if you look, on the way up, it's pretty good in an uptrend. As long as we hold that chandelier exit, things are okay. And I would always tell you that, remember, one break doesn't complete it. You want to look for follow through, which is why this sort of signal here in mid-June of last year, pretty good indicator that this uptrend leading up to that move was most likely over. So those are some of the things that I might look at as a way of exiting a position. For me, as long as the trend is still up, I'm still going to want to own something. I don't want to own something when it stops going up. And so those are some of the tools I would look for to make that assessment. Here's question number 2. How risky is an investment into SSRM with a chart like this? SSRM is a mining name. I'm using your chart that you sent with your question, and thanks so much for doing that. And you had, sort of elaborated in your question, is a big drop a good opportunity? I thought that was an interesting way that you asked that. This is a perfect time for one of my favorite jokes, and this is Tyler Wood, who's at the CMT Association here in Dubai, based in New York. Used to tell this joke at conferences, and it's a fantastic one. He would say there's a fundamental analyst and a technical analyst at dinner, and the fundamental analyst knocks the knife off the table, and the fundamental analyst catches it, and it goes into his hand, cuts his hand catching the knife. And the fundamental analyst looks at the technical analyst and says, "Why didn't you catch that?" And the technical analyst said, "Well, I don't catch falling knives." "Why did you catch it?" And the fundamental analyst said, "I didn't think it was going to fall that low." Love that joke. And the point of that is that technical analysis, as a discipline, really teaches you to stay away from things that are in established downtrends. Kind of the opposite of the first question that we got today. I am not a fan of buying things when they're in an active period of deterioration, what I call a distribution phase, making lower highs and lower lows. Price usually goes down for a reason. So when a stock is in a free fall, it's usually not a great opportunity to, in general, in terms of a timing tool, to buy it. Now, if you're buying something like SSR mining down here, it's not from a technical point of view, I would imagine. It's probably more of a fundamental thesis. This thing is something about valuations, right? When the price goes down so much and the company's earnings remain relatively stable, even if they come down quite a bit, the valuation, meaning how much you're paying for each dollar of earnings, becomes more attractive because you're paying less for a company that has a certain earnings expectation. So valuations become more, intriguing, and then it becomes, potentially a better buy. But the chart is telling you that the price is going down, and so I'm a fan of waiting for signs of accumulation. So, what would you look for? I would say at this point it's a fairly risky position to take. If you would take it, I would certainly be looking at this big spike lower, which looks like it's an earnings-related event. I would be watching that low like a hawk. That's around 375, and as long as we hold that, that's your short-term tactical level of support. But I don't have a lot of confidence that that level is held given the trajectory that we've seen. So I like to use indicators like the MACD or the PPO, looking at the RSI for it to come out of that oversold region. Here's my chart of SSRM. Just to show you, again, with your chart, which was great, just to see how some of the indicators I'm usually looking at what they would tell you. Yes, so you were looking at a weekly chart of SSRM. Here's my daily chart. So you can see it's pretty oversold, right? We're well below that 30 level, so looking for a break above there. The MACD indicator I'd probably use here. It's obviously underperforming. I don't think we need a line to tell us that. So looking for signs of accumulation, looking that investors are buying into weakness. At this point, I'm really not seeing that. It's gone down a lot, and now it's stabilized. So it's not actively going down at the moment, but it's certainly not going up. And I like things that are starting to go up again. So that's how I would kind of think of that type of chart. And I appreciate you looking at the weekly chart first. I think that's a really thoughtful way of approaching this. And I usually skip that whole thing just for time on the final bar. But in my own practice, I would usually look at a weekly and daily chart for most names, just to think about those different time frames. Next question. I've detected an almost fully formed cup and handle on SNA, that's Snap-on Inc. When would you consider this a confirmed breakout? And also, you sent an ACP chart this time. Thanks so much for sharing your chart with me. We're taking a look at it here. Right, so this is SNA, and I am familiar with this name. Now, I should make a note. You actually sent this question a couple weeks ago, so I'm a little late getting to this one. I had a bit of a backlog in the mailbag, so getting through some of the questions, I really wanted to make sure I made time for. And I really like the question because you're highlighting this, which I would argue is a pretty well defined cup and handle pattern. Cup and handle pattern happens after a rally. And you have this big rounded bottoming pattern and then a shallower pullback. I should mention this event, by the way. The cup and handle pattern came from Bill O'Neill, famous market strategist who started William O'Neill and Company, which includes O'Neill Global Advisors. It's pretty impressive how that firm has grown based on the methodology of William O'Neill. He passed away a couple years ago, but William O'Neill sponsored the event. We had the head of the firm and a couple others that attended and spoke yesterday, which was a lot of fun to really celebrate the legacy of a legendary investor like Bill O'Neill. But so he would be smiling about us talking about this pattern here in 2024, I think. This rounded bottoming pattern and then the shallower pullback is a cup and handle. And what's most important is this dashed line that you drew, which is the neckline. And when you break above the neckline, that's a pretty good buy signal. I wanted to highlight this because I would say at this point, in late January, it's a pretty good buy signal. I think that's a classic cup and handle pattern. That's certainly a confirmed buy signal. I think that's a pretty bullish chart. It didn't work out. And I think while some may only show examples of charts that worked really well, I live in the real world, as I know you do too, and sometimes the signals don't work particularly well. This is one where hopefully you have a good money management system in play. You're actually using an average true range-based trailing stop here. So this big gap lower kind of violated the stop. This has been a frustrating name because you basically broke down, invalidating that breakout. Again, before the breakout, it looked like a great chart, and I think a very valid bullish technical pattern. It didn't work. You got stopped out probably on that day. And then from there, we went a little lower and now have reversed back up. So Snap-on has been a fascinatingly challenging chart here. I would agree with your assessment that was a pretty bullish entry point. Confirmed cup and handle pattern. I think that was a good one. Didn't work out, and boy, I wish they always did, but that one certainly did not. Good reminder that I love people often look for like the holy grail, that signal that always works, and then you look at an example where it didn't work. You're like, well, what happened? And my answer is that sometimes they just don't work. And I wish that wasn't the case, but if it wasn't the case, then we'd all use it and wouldn't have to work so hard. Anyways, that's your answer, and thanks for that question. Next one: how do I add shelf volume to a stock? So shelf volume is basically a way of saying a couple ways that we call this: volume at price, volume by price. I've seen on different platforms. I think we call it volume by price. I actually forget what we call it, but let me look it up here. You want to go to the overlays section below your chart, volume by price. There we go, yeah. And then hit update chart. So what this is going to do is put these bars on the left y-axis, and ACP, our advanced charting platform, has a similar, same indicator. It looks a little different, but same general idea. And the general idea here is that you're looking at a distribution of volume, right? So what this is doing is basically saying the volume in certain price buckets. And so if you look at the width of the histogram, it's showing you the price range that it's operating on. And it's basically, I think this defaults to 10, that sounds right, 10 or 12 bars, maybe 12 it looks like. And I think what you can do here, I'm pretty sure, is with the parameter is you set a number. Yes, this is where you can set a number of bars that you use. So I made it 20, which means it takes this y-axis and separates it into 20 equal parts. And it's equal by value. So you can see the bars here are a little narrower than the bars there because I'm using a log scale chart. So it's going to look a little skew, but that's how the math works out on a log scale y-axis. And the reason why you do this is because it helps you focus in on where the market has had a lot of activity. And that is a methodology really came from Pete Stoudemire, who created an indicator called Market Profile. He had a whole, and he wrote a book years ago, which was pretty good sort of thought-provoking, unique approach to visualization, where he talked about distributions in the market, and particularly he was looking at commodities and futures prices, and talked about how markets tend to have a distribution and thinking about how it fills in that distribution. One of the things you look for is high volume areas, and that is usually an expected level of support or resistance. And the idea is because similar to traditional price support and resistance, right, we spend a lot of time at a particular level, the market has memory, and that's how it's pretty important. So that's the general way of doing it. You want to add it under the overlay section. It's called volume by price. If you leave it blank, I think it defaults to 12 buckets equally dollar amount. But if you want to put in a parameter to hard code the number of bars, you're welcome to do that as well. Next question. It's kind of volume day here on the mailbag. Why don't you show volume on your charts? Yeah, and good observation. This was the chart that you sent, PANW, and I see you have the volume. This is kind of a classic look for the Stockcharts charts. And you have the red and black color-coded volume down here. I mean, years ago, I would say a couple of reasons. I don't use volume a ton day to day. That's not untrue. I use volume a lot more earlier in my career. I've used it less and less over time. In general, to be honest, I didn't find that it added a ton of value for my perception of market dynamics beyond what I was able to understand using price and a lot of the tools that we talked about, thinking about price momentum and thinking about relative strength. And most of my toolkit is trying to answer those three questions. What is the trend? What is the momentum? And how does this compare to other things? Those are the three general takeaways I'm trying to bring out of a chart. And then I have different indicators to try to supplement that with other specifics. Volume for me is something that I think, the way that the markets have evolved, it started with decimalization. It continued with dark pools and regional exchanges, rolling over, electronic trading, how trades are reported. I think volume in 2024 means something very different than it did 50 years ago, different than it did 20 years ago when I was getting started. So I would say that, for me, volume has become less important. And I don't want to say it's unimportant because some people will use volume all the time and find it to be an incredibly important input in their process. That's great. I have to limit the number of things that I look at, as you probably do too. I like to keep it simple. For me, volume is just, it ends up being excessive, I think, for what I'm trying to do. Again, I don't want to say that that's wrong because, again, there are indicators I don't use that I think are fine indicators. I just don't need all of them at every moment. I do look at volume occasionally, and when I do, I often use something like Chaikin money flow or accumulation distribution. Say some of the other commentators on Stockcharts, like Tom Boley, does a good job highlighting accumulation distribution and what that means. The good folks at Chaikin, including Mark Chaikin and Pete Carmesino, whose work we feature on Stockcharts at times, do a good job of highlighting some of Mark Chaikin's indicators that are basically, I think, better versions of just looking at daily volume reading. So that is my quick diatribe on why I don't use volume. Next question, how good is the VIX as a predictor of volatility? Isn't it just backward looking? You actually had a really thoughtful question. I don't have time to go through the entire text of it, but I would just tell you, you basically said the VIX is the claim of the VIX, or the expectation of the VIX, is that it assesses forward risk, right? So, it's suggesting to you what the risk kind of is. Actually, I don't want to go to that chart. Let me look at this one. But you were saying, you're basically, the volatility spikes when the market moves. So isn't it just telling you about the current volatility, right? Is it really an expectation of future volatility? What you have to remember is, if you know volatility, if you've looked at the options market, there's kind of two ways you can define volatility on any series, not just the S&P, but on an individual stock or anything like that. As long as there are options traded on that as an underlying. You can look at what's called historical volatility, which is actually the volatility of the series. How much does this tend to move? So something like average to range is a form of historical volatility. It basically defines how much a stock has moved over time. The other thing is what's called implied volatility, which is you look at options, the options market for an underlying stock or index, and you look at the volatility in the options, and the volatility in the options implies the volatility expectation for the underlying stock. A lot of times options will price in future volatility and expectations of how volatility is going to evolve, because that's a big part of how they're priced. And so the VIX is basically an implied volatility reading for the broader market, because it looks at index options for the S&P 500, looks at a bunch of them and does a whole calculation from the CBOE to create this VIX. And there are a bunch of derivative indicators based on that, that initial premise, but that is the general idea of it. So, in a lot of ways, it is kind of a measure of both, but it really is trying to tell you about the expectations of future volatility. And it's just, again, there's no crystal ball. If you're looking for a volatility crystal ball, that doesn't exist, right? That's sort of like what indicator can tell me where the price is going to be a month from now? Now, it's not possible. And if someone tells you it is possible, I think they're lying to you or themselves or both. That's just not something we have. We're not able to predict the future with any sort of, consistency. But we can analyze the current market. So I think the best expectation you can look at for volatility of something like the S&P is to look at the options traded for the S&P, look at the volatility there and what the options market is pricing in for expectations of volatility, and using that to imply what the volatility is going to be for the S&P. And that's how you justify the VIX as a sort of a forward-looking measure of volatility. Again, if you're looking for a crystal ball on anything in finance, we don't have it, as much as some would insist that we do. My experience is that is a mirage. And so that's why the VIX is used. That's what it's actually doing, and why it's an expectation or a predictor of volatility. Next question, is LABU the new NVIDIA? Is it too late to get in? It's funny, and before I even brought the chart up, anytime someone asks, is it too late to get in? My answer is usually no, because what that implies is something's gone up and you're concerned that you missed it. And I feel like gravestones on unsuccessful investors have that quote, and it's basically a missed opportunity fact, right? It is rarely too late. I think that idea of being too late has prevented people from getting into winning stocks and winning trades way more than it's helped them avoid, the top, which is what we don't want to be that last person buying the top. The chances of that happening are actually quite low. Generally speaking, if you buy things in a position of strength, you're probably going to ride it to further strength. Something like LABU. So a couple questions on this, though. What's actually very interesting is, since you sent this question in, it dropped 9%. That is, I find, absolutely hilarious. It was overbought as you're asking that question, which is something we'll talk about in a moment. So first things off, is LABU the new NVIDIA, which is your question, the first question? No. And I would tell you because, number one, this is a leveraged long biotech ETF. So if you really want to talk about biotech being the new NVIDIA, I would use something like IBB, or use a particular biotech name like Biogen or Amgen or Regeneron or one of those names. That is more of an apples to apples basis. I think leveraged ETFs are not a good data series to make that general assessment. So I think, is biotech something that is I think what you're asking is, NVIDIA had that consolidation that broke out and then had an extended run. Your question is biotech sort of earlier on? I think it might be. It pulled back today, and I'm recording this Friday morning Dubai time, so before the U.S. market opens on Friday, but on Thursday, down almost 2%. And so, but I think overall the thesis is still there. It broke out, it's pulling back. Does it make a higher low? This could be a good breakout of a base, as long as it's able to hold that on a pullback. Your chart, LABU, is a triple leverage biotech ETF, and I'm not a big fan of analyzing the data series with this. I would much rather analyze the IBB and then use something like a leveraged ETF as a way of expressing a conclusion on biotech. I think biotech's bullish, but instead of buying the IBB, I'm going to buy a triple leverage because I have a very high confidence that it's bullish. That is how I would generally think of using leveraged ETFs. And just remember, these are intended to be short-term instruments, not long-term instruments. There's a lot of issues that you have the longer you hold a leveraged or an inverse ETF, just the way that they're calculated and the way that they're actually creating that data. So is it too late to get in on a chart like this? Forget that it's LABU. The second half of your question is, how do you know it's too late? I don't think so, right? And I would say that you should never be afraid to buy new highs. From a tactical perspective, buying something that's overbought, I think you have to be prepared that you're going to be buying into a pullback. So you're going to have most likely an initial loss as we pull back from overbought conditions. That is just the nature of things that become overbought. Does that mean that's going to be the top and we're going to go back to 50? Maybe, but not necessarily. I would say anytime something becomes overbought, it's often, if the longer term trend is up, that often just means you're at the upper end of this channel. We pull back, and it could mean, maybe wait for a higher low, and that's the time to get in. That might be the more astute way of thinking of this particular pattern. So is it too late in terms of the uptrend? Certainly not. I'm seeing nothing on this chart that would tell me that is the takeaway. Is this a perfect time to be pulling that trigger? I would say buying into charts that are overbought means you have this as a very real risk, which is you're buying, just before you pull back to make a higher low. What I've learned about charting is think of this on different time frames, right? The medium term trend is still positive. Maybe in the short term we pull back and make a higher low. So tactically, maybe we buy on pullbacks. That's a better way to get filled at a more optimal level and try buy at the lower end of this channel, not the upper end of this channel. That's how I would answer that. Final question for this special all mailbag edition. How can I be notified when a new episode of The Final Bar is posted? This actually came back. You had answered our survey and wrote a separate email to me, and I thank you so much. And so many of you answered our survey recently about this show. We want to thank you so much for the great responses. We're in the process of gathering those and going through the comments that you shared and really thinking about how we can improve Stockcharts TV, how we can improve this show, The Final Bar. It's kind of a weird week doing it from the Middle East, but starting next week, hopefully we're back at a normal time zone for me and for the show. I think we'll all feel a little better about that. But we have rotated the show from being live right at 4 p.m. Eastern to doing it a little delayed. This is making it much easier for us to produce the show because we're able to do the interviews with our guests at a better time. We're able to edit things if there are any issues. We often have technology issues with the show. You may not know that because our video production team is top-notch and they do a great job of making challenging technology situations seem not that bad. But I will tell you, seeing behind the scenes, it's a lot of work and often creates some issues when you try to do something live, especially with all the remote guests that we try to bring in from all around the world. So doing it on delay a little bit and being able to edit and make sure we can tighten up the technology makes a better finished product for you. But we're in the process of sort of reevaluating that overall thinking. We appreciate all of you sharing some feedback on that. We'll take that to heart, and we're going to have some strategic meetings here in the next couple weeks to think about this show and the Final Bar. But to your question in particular, which is how do you get notified? Two things I will tell you. Number one, on YouTube, and I will go to our channel here, what you want to make sure is that you are subscribed to the channel, which is Stockcharts TV, and then make sure that you go to, and I have them turned off just because I know when we're posting a show because I'm behind the scenes, but if I was not working at Stockcharts, I would make sure I'm getting notifications. So if you do that, what it's going to do is it'll pop up on your when you bring up YouTube. It'll also send you a notification on the YouTube app if you look at us, watch us on mobile. And so that's probably one of the best ways for a built-in YouTube capability to get an alert. You should also know that we actually post an article for every episode of The Final Bar on our website. So if you go to the articles tab on Stockcharts and go down to go to the blog called The Final Bar, we'll post it here on this main blog roll. Every time we do a show, our editing team puts together an article that has a quick summary and then a link to the video. So you can actually put your email here on the right side of this, and you will get an email triggered every time we post a new video to our blog. We're also looking at just this whole methodology and see if we can do this a little more timely than we have. But those are the two ways that I would think of it. If you have both of those boxes checked, you will not miss a new episode of the Final Bar. That's it for this special all mailbag edition. I want to thank you guys so much for hanging with us this week. It's been so fun meeting many of you here in Dubai at the CMT 2024 Summit. It was such a pleasure. What a fun place and a fantastic group of people. Really enjoyed putting some faces with the names that I've seen on social media, on LinkedIn, on YouTube comments. Knowing that you're real people with some really thoughtful questions and comments has been a real pleasure. Wish you guys all safe travels back home wherever you're at. And for those of you watching wherever you're at, have a fantastic weekend. Be well, stay safe. We'll be back next week in Redmond, Washington. Till then, have a great weekend. Bye now.